everyone. Welcome to EduTap and welcome to today's Finance 360-degree session in which we are going to discuss a very important notification that has been recently released by the Reserve Bank of India, in which the Reserve Bank of India has revised the add-on factors. Okay, so where the add-on factors have been revised, in which particular contracts, and how these have been revised, all of this we are going to discuss from the examination perspective. This is very, very important, as well as it is quite technical also. So we will discuss it in the manner so that you are able to understand. Okay, so a very important notification has been released by the Reserve Bank of India regarding the add-on factors that we are going to discuss in today's session. And I have broken this down so that you have the clear understanding. Okay, so first of all, give me a thumbs up if I'm clearly audible and the screen is visible. Good morning, Fruity. Good morning, Akshu. Good morning, everyone. So welcome to the session. So RBI has tightened the counterparty credit risk rules for the commercial banks. The add-on factors have been increased, or there is a change in the add-on factors that have been brought for the market-related off-balance sheet items. Okay, so let's understand the whole guideline. Let's understand the key terms in the easy manner going forward. So now, before starting with the session, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. Okay, so you will get the PDF in the Telegram channel. Now let's get started with the article. So I hope I'm clearly audible. Okay. So the Reserve Bank of India Commercial Banks Prudential Norms on Capital Adequacy Third Amendment Directions 2026. So basically the RBI has brought a major amendment in the prudential norms on the capital adequacy. I hope that everyone knows that the different banks, let it be the payment banks, let it be the small finance bank, commercial banks, they have to maintain the adequate capital. They have to maintain the adequate capital with themselves. Why do they require the adequate capital? Why should the bank maintain the adequate capital with themselves? So the bank has to maintain the capital adequacy. The bank has to maintain the capital adequacy so that the bank can handle the distress situation if there is any stressful situation, if there is any liquidity crunch that is happening, or if there is any distress situation that is happening with the bank. With the help of the adequate capital that the bank is maintaining, the bank can handle such kind of distress situation. Okay, so against the risk weighted assets, see, the banks have different assets. The bank has the loans that the bank is providing. So bank is giving the loans against which the bank will get the interest. The bank also has the other market related transactions, or let's say the bank has different financial instruments that are the assets of the bank. Now these assets have some risk weight. What if the financial instruments, their prices are volatile? What if their prices decline and the bank make losses? In the loans also, the loans are also very risky, that what if the borrower do not return the loan? Okay, so the loans and the financial instruments, they are risky. They have some risk weight. Certain loans, let's say the loan is given to the central government, it has 0% risk weight. The loans given to the state government has, let's say, 20% or 10% of the risk weight. The loans given to the corporates, let's say it has 50% of the risk weight. The loans given to the micro, small and medium enterprises, let's say it has the 70% of the risk weight. The financial instruments, let's say it has 80% of the risk weight. So different assets of the bank that is earning some profit, that is earning some returns, that is earning some interest. So different assets of the bank has different risk weight. Okay, against these risk weighted assets, because the assets have risk attached. Okay, the assets, the loans, the financial instruments, they have risk attached. They are risky. Okay, what if some of the loans do not come back? What if the financial instruments prices drop? So the assets have risk weight, and against these risk weighted assets, the banks have to maintain the capital. Okay, the banks have to maintain the adequate capital. This is known as the capital to risk weighted asset ratio, the capital adequacy ratio. The bank has to maintain the adequate capital against the risk weighted assets. Now for the commercial banks, what is the CRAR? For the commercial banks, the capital to risk weighted asset ratio is how much? Is it 15%? Is it 12%? Is it 9%? What is the capital to risk weighted asset ratio? It is 9% for the commercial banks. For the small finance banks, for the payment banks, what is the capital to risk weighted asset ratio? What is the CRAR that the small finance banks, that the payment banks have to maintain? I hope you remember that the small finance banks have to maintain the CRAR of 15%. The payment bank have to maintain the CRAR of 15%. Okay, so this is the idea that all the banks, they have to maintain adequate capital with themselves. Commercial banks have to maintain the CRAR of 9%, and the small finance bank, payment bank have to maintain the CRAR of 15%. So this is the requirement, that there should be capital adequacy that the bank should have. The bank has to maintain adequate capital, and regarding that there are some prudential norms which have recently been amended. So this is the crux, or this is the basic idea that we are going to discuss. Now RBI has decided to amend the Reserve Bank of India Commercial Banks Prudential Norms on Capital Adequacy Directions 2025 to provide greater clarity. Now why the amendment has happened? To provide greater clarity and to largely align the capital adequacy norms, the prudential norms, with the international standards, okay? So this is the idea, that the amendment has happened to provide the clarity regarding the capital adequacy norms, as well as to largely align the capital adequacy norms with the international standards, okay? And this has happened for the commercial banks. There is also the guidelines that is released for the small finance bank, for the payment banks, and for the all India financial institutions, okay? So basically the RBI has also amended the prudential norms on capital adequacy for the small finance bank, payment bank, and all India financial institutions and the commercial banks, okay? Now these amendment directions shall come into effect from the date of the issue, that is immediately these amendments are applicable, as well as the applicability of the direction is on the commercial banks, small finance banks, payment banks, and all India financial institution. That is the idea, okay? So I hope the basic idea is clear, that okay, the amendment has been brought, in what guidelines the amendment has been brought. Now before moving forward, first we have to understand that what is the counterparty credit risk, because the traditional credit risk, we understand it very clearly, okay? But what is the counterparty credit risk, that we have to understand. See, in the traditional credit risk is basically the loans that the bank is giving. If the bank is giving the loan to the borrower, where the risk is, who is handling the risk, who is having the risk? Does the borrower have the risk or the bank has the risk? In the traditional credit, that means the loan that the bank is giving, in this case, which party has the risk? The bank has the risk or the borrower has the risk? The bank has the risk, because the bank is providing the loan. What if the loan does not come back? What if the borrower defaults? So the bank has the risk. That is a unilateral risk, we can say. This is a unilateral risk, and the bank knows that okay, 10 lakh rupees has been given as the loan, so this is the exposure of the bank, okay, against which, so this is the 10 lakh rupees that is given as the loan. This is the exposure of the bank to the borrower, and against the exposure the bank has to maintain the capital against the risk weighted asset, okay? Now in the case of counterparty, credit risk, basically the counterparty credit risk says that the risk is bilateral. That means both the parties have the risk. Now in what case both the parties will have the risk? So usually in the off balance sheet transactions, that is usually in the case of financial instruments like the derivatives, both the parties have the risk. Have you heard about derivatives? So derivatives are what? Derivatives, they derive the value from some underlying asset. Derivatives are the financial contracts that derive their value from some underlying asset. It can be stocks, it can be interest rate, it can be the currency, the foreign currency, okay, it can be gold or like other precious metal and such. So basically derivatives are the financial contracts between the two parties, and the derivatives derive their value from some underlying asset. It can be shares, it can be interest rate, or XYZ, okay? So now these derivatives, they are called off balance sheet item. Why they are off balance sheet? Because they are not directly recorded in the balance sheet. In the balance sheet, the loans of the banks are recorded, the deposits that the banks is taking is recorded. So these kind of immediate assets or liabilities, loans are the asset for the bank. Deposits are the liability of the bank that the bank has to return in the future. So in the balance sheet, we record, or the bank record, the immediate asset and liability. So at this point of time, what are the asset and the liability of the bank? That is recorded in the balance sheet. Off balance sheet items are basically derivatives like the future contracts, the forward contracts, the swap contracts, the option contracts. They have some future date. They will be maturing on some future date. So these are the off balance sheet items. They are the future exposure, or they are going to mature in future in the coming time period. Okay, so these are derivatives, are the off balance sheet item that will expire or that will mature in future, and that's why they are not recorded in the balance sheet. They are off balance sheet items. So these off balance sheet items, that is derivatives. So derivatives, that is the off balance sheet item. They are like the forward derivatives or the futures or the options or swap contracts. They are off balance sheet item. Now the derivatives, many of the banks, they are coming into derivatives, they are coming into forward derivatives, or they are coming into future derivatives or options and such. Now these have counterparty credit risk. They have counterparty credit risk. That means, let's say Bank A of India is having a derivative contract with Bank B of England. Now there is a counterparty credit risk that what if the Bank A does not fulfill the conditions or does not fulfill the contract, or the Bank B does not fulfill the contract. So there is a counterparty credit risk that what if a party do not fulfill the contract. Okay, so let's understand this with an example, then you will have better clarity. But this is the basic idea that the traditional credit risk is basically the unilateral one-sided risk. The bank is providing the loan to the borrower. So bank has the risk. Now the bank know that how much is the risk. The exposure is stable. We know that, okay, the bank has given 10 lakh rupees. So this 10 lakh rupees is the exposure of the bank. This is the asset, or this is the exposure of the bank. Okay. So who loses or who is at the risk? The lender, that is the bank, is at the risk. But in the counterparty credit risk, that is the derivative contracts or the market transactions that is happening, the financial instruments that are being signed, they are off balance sheet. If they are off balance sheet item, basically, that means they will be settled in the future, they will be maturing in the future. So they have a counterparty credit risk. That means both the parties, any of the party can default. Indian bank can default or the foreign bank can default. Okay, so any of the party can default. So either party, both the parties basically have the risk. Both the parties have the risk, as well as there is uncertain exposure that we will discuss. Okay, so basically take this example. Let's say that the Indian bank wants to have $1 million. Okay, the foreign bank has said that, okay, the foreign bank will provide the Indian bank the $1 million after 3 months. Okay, so the foreign bank has agreed to provide $1 million to the Indian bank after 3 months at the rate of 83 rupees per dollar. Okay, 83 rupees per dollar. Okay, so we will have to give 83 million rupees to get $1 million. Okay, so this is the basic idea. So Indian bank wants $1 million. Foreign bank has agreed to provide the $1 million to the Indian bank at the rate of 83 rupees per dollar. Now this is a forward derivative contract. Where the two parties have agreed to do the transaction, and the forward date is after 3 months. That after 3 months this settlement will happen. Now let's say that right now the Indian bank has agreed to purchase $1 million from the foreign bank at 83 rupees per dollar. Okay, what if after one month, now the contract will be settled after 3 months, but after 1 month, let's say now per dollar is equal to 85 rupees. So if the foreign bank provide per dollar at 83, if the foreign bank provides per dollar at 83 rupees, so is it a loss for the foreign bank? Yes or no? Is it a loss for the foreign bank? Yes. If the foreign bank provide the Indian bank $1 million at 83 rupees per dollar, so it is a loss. It is a loss for the foreign bank, because right now it can sell the dollars at 85 rupees. So 2 rupees per dollar is the loss for the foreign bank, while for the Indian bank this is a profit. Because if the Indian bank is getting it the per dollar at 83 rupees, it does not have to pay 85 rupees per dollar. That means the Indian bank is making the profit of rupees 2 per dollar. Now, because the foreign bank is making the loss, it might default. It might say that, okay, we do not have dollars to give. We do not have dollars to give. So it can say that, okay, we do not have dollars to give and we are getting out of this contract. So Indian bank is exposed to the foreign bank in this case. In this case, the Indian bank is exposed to the foreign bank. So Indian bank has exposure. And what is the exposure of the Indian bank? 2 rupees per dollar. That is 2 million rupees, we can say, basically. So 2 rupees per dollar is the exposure of the Indian bank for the foreign bank. Is it making sense? So basically, Indian bank and the foreign bank had agreed to provide, the foreign bank had agreed to provide $1 million at 83 rupees per dollar. But now after 1 month, per dollar is of 85 rupees. So if the foreign bank is providing the dollar at 83 rupees, this is loss for the foreign bank, but this is gain for the Indian bank at 2 rupees per dollar. The Indian bank is saving 2 rupees per dollar. Okay. So now if the foreign bank defaults, it is the Indian bank is exposed to the foreign bank, and if the foreign bank defaults, the Indian bank will be making the loss now. Okay. In the second case, what happens that after 2 months, let's say after 2 months, now the per dollar is 81 rupees. Per dollar is 81 rupees. The Indian bank has agreed to pay 83 rupees for per dollar. So now the foreign bank is making the gain. Now the foreign bank is making the gain because foreign bank is getting 83 rupees rather than getting 81 in the market. So foreign bank is making the gain of rupees 2 per dollar. So basically the idea is that the exposure is uncertain. The Indian bank may be at the exposure or the foreign bank may be at the exposure. Whichever party is gaining, it is at the exposure. Because if this other party defaults, then the gaining party will lose. So this is the idea that there is uncertain exposure. Any party can be at the exposure. If the party is gaining, let's say before the Indian bank was gaining, so Indian bank was exposed to the foreign bank. In the second case, the foreign bank is gaining. And in this case, if the Indian bank defaults, then the foreign bank is exposed to the Indian bank. So there is uncertain exposure because of the volatility in the market. There is a lot of uncertain exposure and both the parties can be at the risk. So this is known as counterparty credit risk. Okay. So this is the idea that in this case, when 81 rupees per dollar, in this case, when there is 81 rupees per dollar, the foreign bank is gaining and the Indian bank is losing because Indian bank has to pay 83 rupees per dollar while it could have paid only 81 rupees in the market. Okay. So in this case, the Indian party is losing and the foreign party is winning. Okay. So foreign bank is exposed to the Indian bank. So whichever party is gaining, it is exposed to the other party. And if the other party defaults, then the gaining party will lose. And that's why there is uncertain exposure. Both the parties can be at exposure. Both the parties can be losing. Any of the party can lose. So that is counterparty credit risk. In the case of traditional risk, there is only unilateral risk. But in the counterparty credit risk, in the derivative contracts that are off balance sheet contracts, in this case, both the parties are at risk. So counterparty credit risk is the risk that the counterparty, that is the other party to a transaction, could default before the final settlement could happen. So CCR, that is counterparty credit risk, creates a bilateral risk of loss. The gaining party might lose if the other party default, and the gaining party can be any party, the losing party can be any party. Okay, so both the parties have the risk in the derivative contracts. Now, if the bank has the risk, if the Indian bank or the foreign bank has the risk, okay, so they against the risk, they also should maintain some capital. So that is the CRAR. CRAR basically states that against your risk weighted assets, so if the Indian party is gaining, basically in this case, the Indian party was gaining. We were saving rupees 2 per dollar. So nearly we were saving 2 million rupees against the dollars. Okay. So in this case, Indian party was exposed to the foreign bank. Okay. So there is some risk weight to the gain that we have, to the asset that we have. Against the risk weighted asset, the banks have to maintain the capital. Okay, so in the counterparty credit risk also, against the risk weighted assets, the banks have to maintain the capital. Okay, so how much capital the bank has to maintain? The commercial banks have to maintain 9% of the CRAR. The small finance banks, the payment bank has to maintain 15% of the CRAR. Okay, so this is the idea. Any confusion? If default happens, the banks will have to use its capital to handle the distress, to handle the loss, as well as the banks also maintain some provisions that will help the bank to handle the loss. Okay, so if the default happens, then that's why against because the asset, because the contract, because the asset, if you are gaining basically, your asset has some risk weight, that what if the other party defaults? So against your risk weighted asset, you have to maintain certain capital so that you can handle the distress situation if the other party actually defaults. So all the assets, basically all the contracts, all the loans, they have some risk weight. So against the risk weighted asset, the bank has to maintain the capital. Okay, chalo. Now coming to the calculation. So basically this is the calculation that is given, or this is the formula that is given that you have to keep in mind. So credit equivalent. Now derivative, do they have stable exposure or do they have uncertain exposure? What kind of exposure do they have? The derivatives, do they have stable exposure? That we know that this is the exposure, that rupees 2 per dollars, or rupees 1 per dollar, or rupees 10 per dollars. Or they have uncertain exposure, that as per the market volatility, it can be 15 rupees per dollar, or it can be 2 rupees per dollar, or 1 rupees per dollar is the change in the price that is happening. So derivative have uncertain exposure. Any party can have the exposure to the other party, as well as the fluctuation in the value can be extreme. There can be extreme fluctuation in the value. Right now you have made a contract of rupees 83 per dollar. Now this price can increase in the market to rupees 100 per dollar. So exposure is very much uncertain. Because of the uncertain exposure, it is very hard to understand that how much is the asset for the bank, how much the bank is actually gaining from the derivative, or how much the exposure the bank has. So because there is uncertain exposure, that's why the derivative contracts or the derivative value has to be converted into the credit equivalent amount through the current exposure method that has been given in the notification that the RBI has recently released, that the derivative value or the exposure, the derivative exposure has to be converted into credit equivalent amount so that we can know the actual exposure that the bank has to the other bank, okay, or a party has to the other party. So credit equivalent amount of the market related off balance sheet transactions, that is basically for the derivatives, that is market related. In the market the transaction is happening and these are off balance sheet items. So what is the credit equivalent amount for the derivative? So this can be calculated through the current exposure method. So credit equivalent amount for the derivative, this has the formula, the current exposure plus the potential future credit exposure. Okay, so current exposure is basically, in this example, let's say the first month is going on. So the Indian bank had decided to pay 83 rupees. The Indian bank had decided to pay 83 rupees per dollar. Right now, the price of per dollar is 85 rupees. So what is the exposure of the Indian bank? How much the Indian bank is gaining? Indian bank is gaining rupees 2 per dollar, and Indian bank has agreed to get $1 million. So that means Indian bank is gaining rupees 2 million by having this contract. So this is also the exposure of the Indian bank. That if the other party defaults, the Indian bank will lose 2 million rupees. Okay, so this is the idea, that Indian bank had made the contract at 83 rupees per dollars. Right now, at this point of time, the per dollar is 85 rupees. 85 rupees per dollar. Okay, so Indian bank is making rupees 2, the profit of or the gain of 2 rupees per dollar, because it does not have to give the extra 2 rupees per dollar. So it is basically making 2 million rupees. Okay. So this is the exposure. So what is the current exposure? That is dependent upon the mark to market value. Mark to market value means the current value of the contract. It does not matter that what was the price at which you signed. What is the current value of the contract? On the basis of that, you can see the current exposure. So Indian bank has the exposure to the foreign bank, that if the foreign bank defaults, then the Indian bank will make the loss. And the current exposure is 2 million rupees. Okay, so that is the idea. So current exposure is easy to find because we can see that what is the current value of the contract in the market. Potential future credit exposure. Now what is the future exposure? Because the contract is not going to finish right now. The contract is not going to finish right now. Contract will finish after 3 months. So we have seen the current exposure. Now what is the future exposure? How much exposure can the bank have in the future? Okay, so to see the future exposure, there is a formula that is used. That is, for the future exposure, we see the notional value, that is the value of the contract, basically the original value and the notional value of the contract, multiplied by the add-on factor that is provided by the Reserve Bank of India for different contracts. So basically, if we want to see the credit equivalent value or amount of the derivative contract, because the derivative contract have fluctuating exposures, they have uncertain exposure. So if we want to see a set exposure for the derivative contracts, if we want to see the credit equivalent amount of the derivative contract, we want to see the current exposure on the basis of the current market value, that is also known as the mark to market value, plus the potential future exposure, because the contract will expire in the future. So we want to see the potential future exposure also, that is calculated by taking the notional value of the contract multiplied by the add-on factor. For different derivative contracts, the RBI has given the different add-on factors. So this is the basic idea to get to the derivative value, the credit equivalent amount of the derivative value. So once the credit equivalent amount is calculated, so adding the current exposure and potential future exposure, adding these two, we have got to the credit equivalent value of the derivative. Okay, deduct any collateral. Let's say the Indian bank has taken a collateral from the foreign bank. Okay, the collateral was worth, so the contract is of $1 million. So let's say the collateral is of $10,000 only. Collateral is 10% of the whole value, let's say. So deduct the collateral, because this is the collateral that the Indian bank has already taken for the security of the contract, for the safety of the contract. Okay, so deduct the collateral, because this is not the exposure of the Indian bank. This money the Indian bank has already got, or this is the collateral that the Indian bank has already got. So this is not the exposure. This money the Indian bank has received. So this is the safety net basically. Okay, or let's say $5,000 the Indian bank has already received as the collateral. So out of the credit equivalent amount, deduct the collateral value, then we have got the exposure that the Indian bank actually has at default. If the other party default, so Indian bank, the exposure Indian bank actually has is, let's say, the rest of the amount. Okay, so against the exposure at default, the risk weight is calculated. Multiply it with the risk weight, and against the risk weighted asset, against the risk weighted exposure, the capital has to be maintained by the bank. This is the basic idea. You do not have to go too much in depth. This is just for your understanding purpose. This you have to remember, that the credit equivalent amount for the derivative contract is the current exposure plus the potential future exposure. This is the credit equivalent amount. From the credit equivalent amount, we see that what is the exposure at default. From the credit equivalent amount of the derivative, we see that what will be the exposure of the Indian bank at default. Okay, if the default happens from the other bank, so this will be the exposure. Now what is the risk weight? That is how much risk there is. So we multiply it with the risk weight, that is we multiply the exposure with the risk weight. Okay, and then against this we are maintaining the capital. This is the idea. Any confusion? Any confusion here? So now the largely why these add-on factors have been provided, why the add-on factor has been provided under the potential future exposure. Potential future exposure is the notional value multiplied by the add-on factor. So why this add-on factor is provided? Add-on factors are provided for the calculation of the potential future exposure in the current exposure method for interest for the different contracts, so that the the potential future exposure calculation can align with the Basel Committee on Banking Supervision guidelines. Basel Committee on Banking Supervision, this is the global standard setter for the prudential regulation of the banks, So basically, to align with the Basel Committee on Banking Supervision guidelines, that is the global standard setter for the regulation of the banks. So to align the guidelines of Indian banks, or to align the Indian banks with the international standard, these add-on factors have been introduced or they have been updated. Okay, so for the interest rate derivative contracts, you can see that these are the add-on factors. For the exchange rate contracts, where the exchange rate, basically the example that we have taken, that we are giving the rupees for the dollars. Okay, so for the exchange rate contracts, for the gold contracts, these are the add-on factors. For the equities, for the shares, stocks, these are the add-on factors. For the precious metals except gold, so precious metal means silver, platinum, palladium, these are the add-on factors. And for other commodities like the agricultural contracts, energy contracts, base metals like aluminum, copper, zinc, and any other non-precious metal commodity contracts, these are the add-on factors. Add-on factors basically multiply with the notional value to get to the potential future exposure, to calculate the potential future exposure. Okay, so this is the basic idea. Let me summarize that. First, we calculate the credit equivalent amount for the derivative contract by taking the current exposure plus the potential future exposure, which is calculated through the notional value multiplied by the add-on factor, which is provided by the RBI for the different contracts. Okay, once we have the credit equivalent amount, that means this is the credit amount that the bank has given to the other bank, or this is the exposure that the bank has to the other bank, okay, that the Indian bank has to the other bank. So we will see through this exposure, or through this credit equivalent amount of the derivative, we see that what is the exposure at default. At default, what will be the exposure? Okay, so exposure at default, once we have the exposure at default, we multiply it with the risk weight, and against this risk weighted exposure, the bank has to maintain the capital. Okay, so this is the idea. So these are the add-on factors for the derivatives for the market related off balance sheet items, that are the derivatives. So these contracts have the add-on factors. Okay, so you can see that the highest add-on factors are for the other commodities. Okay, the lowest add-on factor is for interest rate contracts. So remember that the other commodities has the highest add-on factor, then the precious metals except gold, then the equities, then the exchange rate contracts and gold, and the least add-on factor is for the interest rate contracts. Okay, so they can be said to be the least risky, and that's why they have least add-on factor. The higher the time period for the contract, the larger the time period for the contract, the larger the add-on factor also. Okay, the larger the time period for the contract, the larger the add-on factor is. Okay, so now the revision has happened of the add-on factors. This will improve the risk weight calculation for off-balance sheet contracts, because now the potential future exposure is calculated by taking the notional value multiplied by the add-on factor. So through this credit equivalent amount, we see the exposure at default, that what is the exposure of the bank at default. Against this, we calculate the risk weight and the capital that the bank has to maintain. So with the add-on factors, this will improve the calculation for the risk weight. Okay, one more important point is that in the case of payment banks, there is only the add-on factor that is provided for the exchange rate contracts and gold. That means for the payment bank, the other contracts add-on factors do not apply. For the payment bank only the add-on factor is provided for exchange rate contracts and gold. This is very, very important. A question can come on this, that for the payment bank, the add-on factor is provided for which contracts? For the interest rate contracts, for the exchange rate contracts and the gold, for the precious metal contracts, or for the other commodity contracts. So for payment bank, the add-on factor contract or add-on factor for the contract is provided for exchange rate contracts and gold only. Okay, so this is the idea. Now next point is that, see, certain contracts, let's say a contract is for 3-year time period. A contract is for 3 years time period. Okay, that the Indian bank will get $1 million at the rate of rupees 83 per dollar from the foreign bank after 3 years. Now the contract is for a long period of time. the contract is for a long period of time, and the longer the time period, the higher the add-on factor. The longer the time period, the higher the add-on factor, So to safeguard the bank from this, the bank can have such kind of contracts that are structured to settle the exposure at a specified payment date. That means the bank has decided, the Indian bank and the foreign bank have decided that this contract is for 3 years. But at every 6-month interval, there will be the settlement that will happen of the exposure. That means if the Indian bank is gaining, Indian bank will get the profit. If the foreign bank is gaining, the foreign bank will get the profit amount. So whichever the settlement is, that will happen. The exposure will be settled. Okay. So basically, rather than signing new contracts every 6 months, this 3-year contract has been divided into 6-month part, and at every 6 months the exposure will be settled, but the final settlement will happen after 3 years. So basically the contract design is such that the total maturity is of 3 years, but the reset will happen, or the exposure will be settled, the profit or loss will be settled every 6 months. So the contract restarts every 6 months. Okay. So timeline is such that after every exposure becomes zero, that after every 6 months the exposure of the banks becomes zero. So where is the actual risk? So actual risk is only for the 6-month time period rather than for the total 3 years. So this is the basic idea. So core rule is that after every 6 months the exposure will be settled, the profit and loss will be settled between Indian bank and the foreign bank, so that this long term contract do not become a problem for a particular bank. Okay. So residual maturity. So basically the maturity is 6 months, but the final maturity is 3 years. Okay. So this is the idea. So for contracts that are structured to settle the exposure following specified payment date. So specified payment date is 6 months. If after every 6 months the exposure will be settled, so that the contract is not for a very long period of time. Okay. So even though the contract is of 3 years, but after every 6 months, the exposure is getting settled. So both the banks have some kind of safety. So this is the idea. However, in the case, so add-on factor will be how much? So even if the exchange rate contract is of 3 years, but because this after every 6 months, the exposure is being settled, so there is no add-on factor that has to be maintained, right? Because after every 6 months, the exposure is being settled. Or there is the add-on factor that is 1%. So basically, the add-on factor for the exchange rate contract would have been, for the 3-year contract, the add-on factor would have been 1 year to 5 year, that is 5%. This would have been the 5% of the add-on factor for the 3-year contract. But because the settlement is happening after every 6 months, so 1 year or less, so the add-on factor for the 1 year or less contract is 1%. So instead of maintaining 5% of the add-on factor, how much add-on factor has to be maintained? Only 1% of add-on factor. So I hope this is very much clear, that if the contracts are structured in such a way that even though the contract has a long-term maturity period, but if they are settled in the meantime, if they are structured in such a way that they are being settled after every 6 months, so the add-on factor will be applied on the basis of when they are getting settled. Okay, so every 6 months, so according to that, add-on factor will be applied. However, in the case of interest rate contracts, which have residual maturity of more than 1 year, so the interest rate contract that have the residual maturity of more than 1 year, over 1 year, so they have to maintain the minimum of 0.50% of add-on factor. So in the case of interest rate contracts specifically, if the maturity is more than 1 year, if the residual maturity is more than 1 year, even if the contract is of 5 years or more than 5 years, doesn't matter. If the residual maturity is more than 1 year, so the add-on factor of 0.50%, this is the floor, this is the minimum add-on factor that has to be maintained. Even in the case where the reset is happening after every 6 months or 3 months, doesn't matter. This is the add-on factor that will have to be maintained. So this is the idea, that even if the contract is for the long term, if in the meantime, if in the 6-month time period, the reset is happening, so then the add-on factor will be applied on the basis of when the reset is happening. So add-on factor will be applied on the basis of the 6-month time period. But in the interest rate contracts, if the residual maturity Doesn't matter that when the reset is happening. If the residual maturity is more than 1 year, then minimum of add-on factor will be 0.50%. Okay, so this is the idea. Now coming to the next point, that is the bank can act as a clearing member. The bank can act as a clearing member. Let's say that there is the settlement that has to happen. So in the stock market, in the stock exchange, in the NSE or BSE, in the National Stock Exchange or Bombay Stock Exchange, there is the contract, there is the future derivative that is signed between X and Y, and the bank is a clearing member that is helping in the settlement of the contract, So clearing members, they clear and settle the contracts. Okay, they clear and settle the contracts, they clear and settle the amount that has to be paid. So bank is acting as a clearing member of the SEBI recognized stock exchanges in the equity derivatives and commodity derivative segment. So banks can act as the clearing member that clear and settle the trade between two parties in the equity derivatives or commodity derivative segment. Shall compute. So now the bank, if it is the clearing member, it also has to maintain the counterparty credit risk or the capital for the counterparty credit risk. So even if the bank is acting as a clearing member, because it has to clear the trade, because it has to settle the trade between X and Y, and let's say that the Y is defaulting, then also the clearing member, that is the bank, has to clear and settle the trade even if a party defaults, because the transaction is happening through the stock exchange. So the clearing member has the responsibility to complete the transaction. So in this case also, if the bank is working as a clearing member to clear and settle the trade, in this case also there is the counterparty credit risk that the bank can face if the other party defaults. So in this case also the bank has to maintain the capital against the risk-weighted asset. Okay, so this is the idea. So banks may act as a clearing member in the derivative market, in the equity and the commodities derivative market, in the stock exchange. Even as a clearing member, the bank can face counterparty credit risk if a party defaults. So banks must compute and maintain capital for the counterparty credit risk arising from such exposure. Okay. So the bank does not necessarily trade in derivatives, but if it is acting as a clearing member that clear the trade on behalf of other participants, then also the bank has to maintain, even if the bank is acting as a clearing member, it still has to maintain the capital for the counterparty credit risk. Okay, because if a client defaults, then the clearing member has the responsibility to clear the trade. Okay, so while calculating the exposure in such cases, the add-on factor will be applied for the equity derivatives and for the commodity derivatives, because in these market the bank is acting as a clearing member. Okay, now this kind of provision of the clearing member, that the bank is acting as the clearing member of, or the All India Financial Institution is acting as a clearing member, this kind of provision will not be applied to the payment banks, because the payment banks, they are not permitted to act as the clearing member. That means this particular direction is applied to all the other banks, the commercial banks, small finance banks, All India Financial Institution, but this particular direction is not applicable to the payment bank, because the payment bank cannot act as the clearing member in the stock exchange. Okay, next point is that where a bank act as a clearing member of a qualified central counterparty, usually what happens that when the trade is happening between X and Y, there is a counterparty. There is a central counterparty. There is a central counterparty that acts as a buyer to the seller and seller to the buyer. Okay, so the central counterparty acts as a buyer to the seller and the buyer to the seller and seller to the buyer. Okay, so central counterparty is the counterparty. It is the intermediary that is coming between the X and Y clients, that is coming between two clients. Okay, so central counterparty has the responsibility to clear to settle the trade. Okay, or to complete the trade, and then the clear and the settlement happens through the clearing member. So this is the idea that the central counterparty, it is in between the two counterparties, it is in between the X and Y. Central counterparty has the responsibility to complete the transaction, and then the clearance and the settlement finally happens through the clearing member. Now the central counterparty has the responsibility to clear the trade or to to finalize the trade. So now in this case, qualifying central counterparty is an entity that is licensed to operate as a central counterparty that is permitted by the appropriate regulator overseer to operate between the two clients. Okay, so central counterparty is the intermediary that is coming between two clients so that the trade happens smoothly, and if a party defaults, then the central counterparty is responsible. To settle the trade. Now, where a bank acts as a clearing member. So let's say the bank is acting as a clearing member of a qualified central counterparty. So qualified central counterparty is between the two clients X and Y. Now the clearing member is still a bank. Let's say the bank is the clearing member. So qualified central counterparty is the buyer to the seller and seller to the buyer. Okay. So if a party defaults, then the qualified central counterparty has to complete the transaction so that the other party do not lose. In this case, if let's say the qualified central counterparty is saying that I cannot complete the trade, then again the responsibility will fall on clearing member to clear and settle the trade. That is the idea. So where let's say situation 1 is that bank clears its own trades through a qualified central counterparty. So bank is a clearing member, but it is on its own account the bank is doing a trade. So basically the bank is a clearing member as well as it is initiating the trade, and there is the qualified central counterparty and the trade is happening with another bank, foreign bank, let's say. Okay, so let's say the bank clears its own, the bank is clearing its own trade through a qualified central counterparty. So trade cleared may include OTC, that is over the counter derivative transactions. These derivative transactions does not happen through the stock exchanges, or if there are exchange traded derivative transaction or securities financing transaction, if any of these transaction is happening for the bank is a party to the transaction and the bank is also clearing the trade. So in this case, the bank has to have a risk weight of 2%. Okay, for these kind of transaction, there is the risk weight of 2% that the bank, against this, the bank has to maintain the capital. So this is the idea. Because the qualified central counterparty is there, so if the second party defaults, then also the bank is free of mind, then the bank is safe because the qualified central counterparty has the responsibility to settle the trade, okay, or to complete the trade. So bank is the clearing member and the bank is clearing its own trade where there is the qualified central counterparty and there is the other bank, that is a foreign bank. So if the foreign bank defaults, the qualified central counterparty has to settle the trade, okay, has to complete the trade in this manner. In this case also, the risk weight that is applied is 2% because the risk is still there, but there is minimum risk because there is the qualified central counterparty that can complete the trade. Situation 2 is the bank cleared trade for its client, not for itself. The bank, there is a client X, there is a qualified central counterparty and the trade is happening with Y. So the bank is clearing the trade, or bank is the clearing member for the X party, okay, or the bank is the clearing member and it is clearing the trade of its own client. In this case, if the Y party defaults, then the qualified central counterparty has the responsibility to complete the trade. But what if the qualified central counterparty says that okay, we cannot complete the trade, then again the responsibility will fall on the bank to clear the trade. And in this case also there is 2% of risk weight that is applied, okay. So bank cleared the trade for its client through a qualified central counterparty. The bank act as the clearing member for its client. If the bank is legally responsible to compensate the client, let's say the default happens by Y and the bank is responsible to compensate the client, then the bank, in this case, the bank has to maintain the risk weight of 2%. So that is the idea. Got it? Any confusion here? So where a bank acts as a clearing member, so if the bank is clearing its own trade through the qualified central counterparty, any of the trade, if it is the bank is clearing its own trade through a qualified central counterparty, that means there is a qualified central counterparty that is in between the bank X, that is acting as the clearing member, and the bank Y. So if the bank Y defaults, then also there is a qualified central counterparty that can handle and that can complete the trade. So in this case, the risk weight is applied 2%. Let's say the bank is clearing the trade of its client through a qualified central counterparty. So here the bank is not a part of the transaction. The transaction is happening between X and Y and there is a qualified central counterparty. Okay, the bank is just a clearing member. The bank is just a clearing member. But let's say the bank is acting as a clearing member for its client. If the bank is legally responsible to compensate the client if the Y party defaults, then the bank has to maintain the risk weight of 2% on its exposure. In case the first responsibility is of the qualified central counterparty to settle the trade or to complete the trade. But if in case the qualified central counterparty is not able to complete the trade, then the bank has the responsibility. So this is the idea, okay? So provided that a clearing member is not required to maintain the capital for such transactions for the trade exposure where the qualified central counterparty is present, if there is a legal written document where it has been said that the bank will not take the responsibility to compensate the client, okay? So the bank has to maintain 2% of risk weight if there is qualified central counterparty that is present. So basically the qualified central counterparty has the responsibility to complete the trade, okay? So in this case, if the bank is clearing its own trade through the qualified central counterparty, then also there is 2% of the risk weight. If the bank is clearing the trade for its client through a qualified central counterparty, then also if it is legally responsible to compensate the client if the qualified central counterparty fails, then also it has to maintain 2% of the risk weight, okay? But if it has written document that we will not handle any kind of compensation to the client, then it will not have to maintain the risk weight. Any confusion here? So this is a little confusing, but I hope the basic is clear. So where a bank acts as a clearing member, where there is a qualified central counterparty that is also present. So if the bank is clearing its own trade, in this case a risk weight of 2% shall be applied for the bank's trade exposure to the qualified central counterparty, okay, because there is a central counterparty that is present. Where the clearing member, that is the bank, offers clearing services to its client, a 2% of risk weight also applies to the bank even though there is a qualified central counterparty, because the bank has obligated to reimburse the client if the qualified central counterparty fails, then the bank will reimburse the client. That's why 2% of risk weight against this 2% of risk weight, capital has to be maintained. But if the bank has legally agreed not to pay the client, then there is no capital, then there is no risk weight, okay? That is the idea. Now this is the first question. I hope you will be easily able to answer this question. Try to answer this question. And based on the add-on factors for market related off-balance sheet items, which of the following correctly represents the descending order of add-on factors for contracts with maturity of 1 year or less, okay? Next is a bank acting as a clearing member of a qualified central counterparty has trade exposure arising from OTC derivatives. So if a bank is acting as a clearing member and there is a qualified central counterparty for a trade, if the bank is obligated to reimburse the client. So if there is a client and the bank is obligated to reimburse the client, then how much is the risk weight that will be applied for such trade exposure? So try to answer this question, okay? So this is it. Thank you everyone. Thank you for watching the video, and I hope you were able to understand, though it was a very complicated direction, but I tried to bring it